welcome to the Green Dream video series. In this series, we interview senior members of the responsible investment industry. I'm Natalie Kenway, Global Head of ESG Insights for ESG Clarity. Today, I am delighted to be speaking to Kathryn McDonald, co-founder and Head of Investments and Sustainability at RadiantESG. Thanks so much for joining us, Kathryn.
Pleasure, Natalie.
So, for background, can you tell us a bit about, you're obviously based in the US, how has the US embraced ESG and impact investing versus Europe and Asia?
Yeah, so we have this very barbelled situation in the US where we have some very, very sophisticated ESG and impact investors, and then some of, let's be honest, the real laggards in the world. So I think that collectively, the US is still pretty far behind Europe and perhaps other parts of the world. Certainly when it comes to including ESG in the definition of fiduciary responsibility, the US is definitely not there in any sort of formal way. I think a big difference is, the origin stories of ESG in the US versus Europe versus, for example, Australia. What we see coming out of Europe is this very top-down sort of regulator or even government driven push for ESG, including a lot of definitions. In the US, everything has just been much more bottom-up, driven by companies and, frankly, investors who are just very motivated to see some future-proofing of their assets. Very recently, on the regulatory front in the US, there is, movement from the SEC that looks to be, contemplating requiring some basic environmental information from companies in terms of their filings. But on the other side, we just had this Supreme Court ruling that, basically said that the Environmental Protection Agency is really not allowed to do environmental protection in the way that we've known it for the last 30 years. So we'll see how companies respond. But I would remind everyone that during the, in the former Trump administration, when our former president pulled the United States out of the Paris Accord, it was individual companies. There was this groundswell of commitment to environmental leadership on the part of companies. So again, ESG in the US is this very bottom-up thing. And, we just simply have to be able to work between these two worlds of regulator-led in some parts of the market and investor-led in other parts.
Yes, it's really interesting to see the regulatory environment over in the US at the moment, and we'll certainly be keeping track of that on ESG Clarity. So I was doing a bit of research and I've noticed that you've said ESG is now the boogeyman that the right wing is to point to as evidence that the left is pursuing a social agenda. Can you just explain a bit more where you're coming from with that?
Sure. So this is a disappointing phenomenon, I would say, much like the politicization of the rollout of the COVID vaccine that turned into something that was very political in the United States for reasons that are a mystery to me and others. But we're just coming upon midterm elections in the US, and the fear is that ESG now is just going to be another issue that is used to try and cleave apart the population. And we're seeing this in the press right now, as I'm sure that you have also read. Just read the comment section in the Wall Street Journal when it comes to any piece that's written on ESG or environmental investing. But politicians have really caught on to the fact that calling out these nominally woke companies is just kind of like throwing red meat to their base. And what we see from various right-wing pundits is this purposeful conflation of ESG, which at its heart is economic logic that's oriented on materiality, and values-based investing, which is very different and is something that has been around and popular for centuries, but these two are not the same thing at all. So from an investor's standpoint, I would say that the use of ESG and impact information, especially when it's combined with traditional fundamental investing information, is simply telling us more about companies, specifically reveals more information about what management is doing to reduce risk, to keep its company relevant, to gain economic traction. More generally, how a company is positioned vis-a-vis these very large forces that affect us all, like climate change or like social movements. So as an active equity investor, I really cannot imagine kind of blithely discarding this whole body of information and say, no, I'd prefer to know less. You know, we would prefer to know more. We would prefer to know as much about a company as we can. I will say that on the part of the left is really missing a trick when it hammers on about science and doesn't focus on the people effects of these big changes enough. You know, for example, if we're talking about transforming the energy grid, we have to talk about the social implications of these big changes. We have to put our minds together and think about how we're going to do these big sort of transformational overhauls of our economy from a people perspective. But back to the big picture, arguing that these big changes afoot, again, like climate, like social movements, just don't matter and we should simply close our eyes and wish ourselves back to the 1950s, that's laughable. We instead need to have tough and open conversations about prevention, adaptation, opportunity, and equitable outcomes.
Yeah, that's so interesting. Two of the things I've sort of picked up from that is that there needs to be some education and collaboration as well. And I think that's something that we're talking about a lot in the UK as well, even though we're perceived to be a sort of more advanced in terms of ESG integration, but there's always work to be done, right? So the recent strong performance of oil and gas has reinvigorated the debate around ESG investing, leading to subpar returns. But the point that we try to make on ESG currency is that everyone needs to be working towards a more sustainable economy, society, planet, or there won't be anything left to work on or towards. So what do you say to your clients and investors around that sort of sacrificing of returns?
Yeah, I couldn't agree more with the last point that you make about there's going to be nothing left if we don't do something about it now. But I'd like to start by acknowledging two basic truisms that apply to all investing. You know, number one, there is significant endpoint sensitivity when we're talking about performance studies done over very short periods of time. So, you know, if you rewind the clock a year, you would hear all of the pro ESG camp talking about the outperformance of ESG. Now, you know, come the first half of this year with this rally in energy stocks, and you hear the other side talking about the underperformance of ESG. It's only been a very short window of time that we have to evaluate ESG integration in its modern form. The second point I'd like to make is even the best investment ideas don't outperform in lockstep quarter over quarter over quarter. You know, this is a long game we're talking about here, not a quarter to quarter game. So yes, it's absolutely important that we are mindful, that we recognize performance implications, especially during periods of market stress. But as long horizon investors, we are much more focused on where the economy is headed and which companies are likely to be the winners and the losers of the future. So we believe that ESG and impact information allows us this lens into the true set of threats and opportunities that companies face. And so by using ESG and impact in our analysis, again, we can get just a better view of where companies are headed, if it's oppositional to these big forces, or if it's, you know, if there's a tailwind associated with these big forces. I would like to make another point around ESG and returns. At Radiant, we use ESG and impact information as alpha ideas, and we've demonstrated that these are indeed accretive to active return. But very importantly, these are also beta ideas, which should arguably be even more interesting to all investors. And this, Natalie, gets at the point that you were making in your question. The extent to which best practices of ESG and impact are put to work on a large scale leads to a strengthening of the aggregate economy, making all assets more productive. So this beta argument may actually matter more when it comes to building wealth. And we think that investors are not as tuned into this beta argument as they possibly should be.
Yes, again, so interesting, and comes back to that educational point. Well, that's what we need to explain to them, right? Okay, well, thank you so much for your insights. And we always end the Green Dream with a question on what you do personally to do your bit for the Environmental Society. So do you have a favourite sustainable drink, snack, restaurant, service, product?
Yeah, this is a hard question to answer because I certainly enjoy a variety of snacks, but I would say that as a good Californian, I will ground my answer in this idea of water sustainability. So California is a drought-stricken state, as is the rest of the Western United States. So I have a bit of a boring answer, but there may be a surprise in there too. I was very surprised to learn a few years ago that oranges or citrus generally has a very low water footprint compared to other fruits and vegetables. So I'm going to say, if we're thinking of nutritional value denominated by water usage, I'm going to go with oranges as my favorite sustainable snack.
That's not boring at all. Thank you so much for sharing that with us. And yeah, great to speak to you. Thank you so much, Kathryn.
Pleasure, Natalie. Thank you very much.